Joining us right now is Jeff Currie. He's Chief Strategy Officer of Energy Pathways at Carlyle. And Jeff, what do you think? You're making a pretty big call here. You think the inflation trade is back on. Why?
Well, we look at commodities, they're the best performing asset. Put Bitcoin, oil, and commodities, commodities as an index are up 14% year to date. This is your classic late cycle rally in commodities. We're looking at economic growth around the world. Industrial production has bottomed. It's starting to become expansionary. That's against low inventories, not a lot of spare capacity. And even in oil, it's isolated in places like OPEC. And then you put that in the context of, evidence of supply disruptions in oil, floods in Russia, Mexican production, Cantrell fields on fire, OPEC production cuts. In copper, you have, environmental shut-ins of mines in Panama, or in grains, or in the softs, at least, you have, the El Nino weather shocks. So you put it together, tight markets, very broad-based rally across the entire commodity complex, and you put that against heightened macro tail risks that are being priced in gold. The situation on commodities, I think, is, more room to the upside.
You're calling this late cycle, though. I mean, this is potentially indicative of a stronger economy. You think that that is not long to last, though?
Well, when we look at, the business cycle, you go through a period, what we call a mid-cycle pause, where the system consolidates under the higher rates, higher energy prices, in the case of the most recent environment, slack in the property market. That consolidation, particularly in manufacturing, has occurred, and we're now starting in the second leg of the cycle. And commodity prices typically see a rally at the beginning, come off during the mid-cycle pause, and then you rally again into the second half. And so this is just, classic playbook on commodities. And this is when you most want to own commodities, is this type of environment.
Let me
ask proving true.
More broadly, just because we have the CPI coming out today and because there's so much question about whether or if the Fed will be able to cut rates, I mean, inflation working its way back into the pipeline suggests that would be the worst time to cut rates.
Yeah, and when we look at with commodities, I like to say, if they cut rates, they're going up. If they don't cut rates, because commodity prices are higher. So from a commodity perspective, it's a win-win. It goes back to my point. Commodities are always the best play at this point in the business cycle for that precise reason.
But you don't know or think that this should advise the Fed on any of those directions? You're just looking at it purely from an investor's point of view?
Yeah, I'm looking through an investor's point of view, but also if you take expectations, I'd say the bar is pretty high on the CPI to come in hot to really, create a big shift in expectations. But I think, that the key point here is what we're seeing in commodities is not a one-off. It's very broad-based. The forward curves are backwardated, which is an indication of tightness. We know inventories are low. Capacity is constrained. Again, people will say, well, oil has spare capacity. That's in Saudi Arabia, UAE. Take that out. The rest of the system is capacity constrained, as if metals, aluminum, grain, or the softs. So, the point here is the breadth of this rally. The one thing I learned in my 27 and a half years at Goldman, never dismiss a broad commodity rally. When you can point across the space, oil, copper, alley, softs, coffee, cocoa, sugar, of the breadth of that rally, you don't dismiss it.
You have a call on where any of these major classes might be headed next, maybe oil, because that's so important to the global economy.
Yeah, I think with oil, it's continued underlying strength in demand against tight supplies. Particularly looking at inventory levels, we have not even begun to price in any potential geopolitical risk. Gold, on the other hand, we'd argue is probably beginning to price that in. In fact, I would say gold tells you a lot about what's going on with macro tail risks right now. When we look at gold, all of your normal valuation metrics, declining real rates or weakening dollar that drives up oil are not at play here. It's very mysterious. What can we observe? There's a large OTC buyer, and it's not price sensitive. Historically, when it's something like that, it usually, after the fact, the data comes out, it ends up being a very large emerging market central bank. But I think what gold is illustrating here is that these macro tail risks are not being priced in correctly. particularly in markets like oil right now. It's all over the world, whether you're looking in, places like Venezuela and Guyana, the Middle East, Russia, Iran, other parts of the world. There's a lot of supply risk there. But even without the supply risk, again, I'm going to go back to late cycle expansionary growth, that cyclical strength there underpinned against tight inventories and tight supplies.
Wells Fargo had put out estimates that Costco is selling as much as $200 million in gold bars monthly. I mean, that to me was a bit of a shocker.
Wow. But it goes to say that that's what people are looking at. I mean, gold is making new highs, day after day. And, and it's an indicative of, the type of risk that I think that the market's not giving a lot of credence to. And I think the other thing, too, is this is occurring against these concerns around higher oil prices, food prices, which I think is an indication that you're seeing a shift in how gold is responding to interest rates, inflationary pressures. And so we're moving into an environment. Actually, if you go back, I'm not saying we're going in the 70s or anything like that, but during the 70s, that's the way gold traded. The more recent period is, real rates go down, dollar weakens, gold goes up. But we're in an environment where we're seeing the exact opposite, and it has to be a combination of inflationary concerns combined with geopolitical concerns, which goes to your Costco point. That's what's ultimately driving this underlying demand.
I'm glad to hear you say you're not anticipating the 70s again, but the rhyming nature doesn't make us all feel very good about it. Oh,
yeah, no, I mean, I'm not forecasting it, but the potential for a rhyme is high right now.